Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about some Chinese stocks that I think have some great potential going forward and have seen a decline in price. This is largely going to be a continuation of my video 2 weeks ago covering LEAP contracts on Baidu Inc. One of the reasons that I really like the Chinese stocks right now is that if you look at where the market is going right now, particularly associated with the broader market, we actually saw a pretty large decline compared to what we've seen over the past 6 months. And that occurred this past Thursday and Friday. Now, a lot of that is being held up primarily by the larger tech stocks that are actually continuing to make new highs. Think Microsoft, Amazon, Google, as well as Nvidia and Shopify. So when I say decline, I do want to highlight that overall we're still not even where we were at the beginning of the month of May. So it's important to note that. But what I am highlighting here when we're making these comparisons is that as we look to where the stocks can go, that it's not very difficult for us to believe that the market is going to be declining back into this 405 to 410 area. And what we've seen during this entire time period is that we really haven't seen the Chinese stocks do well because there's still a lot of uncertainty around the current administration and the relationship with China, as well as the growth associated with it. Well, lately we've seen some positive growth numbers from China associated with economic growth, as well as we've seen positive growth associated with the tech boom over there in general. So for these reasons, I think that there's a lot of progress that can still be made. The other item that I would highlight is the past week, the US dollar did very, very well, which means that currently a US dollar will get you more Chinese goods than it would a period of a month ago would have. So all of that points very well to Chinese companies being able to continue to take advantage of lower or a better economic scenario due to the fact that the United States is seeing slower economic growth. So I highlight all of this to continue to point to one of the companies that I highlighted at the end of last year, and one that I continue to think is approaching a nice buy point is going to be NetEase. So if you have been on the channel for quite some time, the last time we talked about NetEase was last year when they were in this $90 range during the December time period. My target for that was $110 a share, and we sold right at around $111, $112. I don't believe I caught it on this first rip right here, but it was the second one, and it actually went all the way up to $130 a share north of that. So now that we've seen a decline, we had 2 very good quarters, and I think that as this stock has continued to decline, you can see being down nearly 3% or just over 3% this past Friday, that if it gets down into that 100 to 105 time period or range, then I'm going to be looking to go back in on NetEase. Again, this is by no means a recommendation because I'm not a financial advisor, but this is a company that is seeing continued growth, as well as their cash position continues to be very, very strong. You can see the debt is growing as well, but by no means at the same level that the balance sheet cash is growing, and all of that is pretty dwarfed by the fact that their overall revenue is continuing to growing at a very rapid pace. You can see by way of annual numbers that they had right at $60 billion in sales in 2019, and that went north all the way nearly to $75 billion in 2020. And again, that earnings run has continued, but they've had very strong earnings in the first quarter of this calendar year. The important thing to also highlight is when we look at net income is that they're continuing to be very profitable, which is something that we really like to see. So the reason I highlight this is because the company has continued to grow. They offer a pretty small dividend here, right at 1%, but I still think that there's a lot of value for it because, again, if I like a company long term, I'm okay with getting paid to play. From a valuation perspective, because you can see kind of the price to earnings ratio at 36, they're a little bit high, but I recognize that the broader industry is high across the board. And for that reason, I'm going to continue to evaluate this as a buy around the 100 to 105 time period and look to sell around the 120 to 125 swing back up. Again, there was a lot of excitement back in the video game stocks during February, March time period. before the subsequent decline in overall Chinese stocks, as well as some of the coming back from the high of overall tech stocks. Now, during this point in time, you can see that we've actually seen those growth stocks that did so well in 2020, Shopify, Nvidia, AMD. We've actually seen that those companies have gone on to hit new highs during this time period, where a lot of these other companies have been left behind. For that reason, I think we may be able to see some of that swing trade action, but if we don't, I still like Netease long term. One other company that I really like is going to be BILI, or Bilibili, which is a Chinese streaming service. Now, this is a company that I showcased this in the chat in the Discord, which is linked in the description down below. But I bought into Bilibili around $28 a share and sold at $38 a share back in, I think this was 2018 potentially, but I talk about this all the time. But so I bought in, back during the 2018-2019 time period, and it went up from like $20 to $30 a share. So it may have been in the 2019 time period. But so sold out then, and to see this stock, they actually hit right at 157 time period. They hit all the way up that high. So this is one that I like a lot. They continue to grow, so it's interesting to see that they had such a large increase in share price this past Friday. But this is another one that they are growing very rapidly, and they are in a very different position than NetEase. So it's kind of one is much more high growth right now, again in the streaming space. But you can see that their total revenue, they struggled during the first quarter to grow, but look at the year over year from 2019 to 2020. So you can see that they went from nearly $7 billion in sales to $12 billion in sales year over year, but they're losing a lot of that money. So this is more of a high growth play, recognizing that they are losing quite a bit of money over that same time period. So what I'm looking for this one in terms of the swing is I'm actually not looking to buy in at the 118, but if they get back down to the 100 to 110, I'll be looking for that exact same move of the 100 to the 120 time period. But this is just one to watch because it could rocket back up, and by no means am I looking to say, hey, this is where they're going to end up and this makes sense. I think, again, at the overall valuation right now, we're very, very high. They don't have price to earnings because they're not a positive earnings company. They're not profitable, but price to sales at 20 is just high enough to say, hey, they could keep running, but just high enough to also say, hey, we really need to see some case for profitability going forward. The other thing I would highlight for both of these companies is they do charge ADR fees, and that's going to be 1 to 3 cents per share. So you have to recognize that change depending on your brokerage, and this is what we can look at for TD Ameritrade, which is what I am using here today. So these are just two companies that I'm very interested in going forward. I'm going to continue watching them. If you wait for me to see a play, you can find that in the Discord, which is in the description down below. And if you find this content helpful, please leave a like and subscribe. Thanks. Talk to you later.